Okay, in this session, what I want to do is something I think is very, very important. Measuring return, measuring risk is so central not just to investing, but to all of finance. And so what I want to do with this video is walk you through probably the four most important formulas in finance. And let's look at each one of them and understand what they measure for risk. We'll talk a lot about beta, especially a little bit later. But the formulas you see all the time in finance are standard deviation, correlation, R squared, which is fairly easy because it's just correlation squared, and then beta. These are all risk measures. In some sense, correlation is an important risk measure because it tells you how two things move together in order to measure what kind of diversification benefit you get from investing in different asset classes. We talked about R squared as part of the first exam when we talked about the term of parsimonious. We want to make sure we have a high R squared between the asset classes we pick in our portfolio to make sure we're explaining as much of the risk as possible. So let's talk through each one of these. I'm going to move these terms over a little bit, and then let's just look at what we have here. We have the stock prices, the adjusted stock prices for Apple. That's why the price is so low at 48 cents, because it's adjusting for dividends and stock splits and those type of things. The S&P is not adjusted. As amazing as it is to think, in 1980 the S&P was only at 135. Today it's, recently it was above 3,000. Now it's back down well below 3,000, but still a pretty hefty increase. So what we want to do is do the holding period return for Apple, and we want to do a holding period return for the S&P. So the holding period return, remember, is any market value minus beginning market value plus accrued income divided by beginning market value. But in our case, the accrued income is part of the adjusted close. So we already have it in there, so our ending market value already adjusts for that accrued income. So all we have to do is take ending market value minus beginning market value divided by beginning market value, or you can also do ending market value divided by beginning market value minus 1, but I'll do it just like we done in class just to prevent confusion. So I'm going to do ending market value divided by beginning market value, minus beginning market value, and that divided by beginning market value. And there's my return. So way back then in 1980, Apple had a really bad month, down 17%. I can copy that over to the S&P. Maybe we'll give it a couple decimal places, or maybe just, let's give it 2 decimal places. All right, so we got those two holding period returns. Let's copy them all the way down to the very, very end. And let's do the arithmetic average. So there's 2 ways to do it. Let's see how many periods that we have. How many months do we have? So I'm going to use the equal count function. So we have 470 months. So the arithmetic average is simply the sum, just like we did before, the sum of all those holding period returns divided by numbers. So the monthly average for Apple is actually a really high number, 2%, if you think about that, because that's monthly. Or we can use the Excel function, equal average. And that's what I want you to get in this session, is how you can do these manually and using the Excel function and see if you get the exact same answer. So there's arithmetic. If we annualize that, we just take the monthly times 12. And so their annualized return is 26.8. Let's do the same thing. That's for, so again, I want you to try this on a blank spreadsheet. I might move around too fast, so I move this stuff down so I have more room. So let's do Apple, and let's do the S&P. So the S&P, we do equal sum of all of its holding period returns divided by the number of periods, 470, gives you a monthly average return for the S&P of 0.75%. We can use the average function and make sure we get the same answer. If we do, so that's good. And then we can annualize that by just multiplying by 12. You can see the average annual return for the S&P average is 9%. That's a really high number because we're missing dividends. Dividends have been 3 to 4%. So you can see the stock market back to 1980 has averaged a return well over 10%, which is really pretty amazing. So what can we do with these numbers? All right, so we'll try the geometric next. So let's do the geometric. The geometric's a little tougher because the math is really lengthy. So what we're going to do is we're going to pretend like we have $1 invested in Apple and $1 invested in the S&P, and we'll take that dollar times 1 plus the return in the first month. And if we had invested $1 in Apple at the end of December 1980, at the end of January 1981, that $1 would have only been 83 cents. Same thing with the S&P. If I invested $1 in the S&P 500 at the end of December 1980, I would have only had 95 cents after that. So we can link all those together. We'll just keep reinvesting. So the next month, if I had taken the 83 cents I had at the end of January and kept it invested in Apple, I would have lost another 6%. I would have been down to 78 cents. I would have lost another 7%. I'd been down to 72%. Then I started getting this one back, and then I lost some. You can see it was very, very volatile. Even with the 31% increase, I'm still down 41 cents. 1981 was a bear market. It was a really tough market. So a lot of volatility, high interest rates. But anyway, when you go down to the very, very, very end, you'll notice that $1 invested in Apple would have been worth $564, and the $1 invested in the S&P 500 would have been worth $21.76, although it would have been quite a bit more than that because of the dividends. So we're excluding dividends. So it's not a fair comparison, to be sure. So the geometric average, we take the product of all those numbers, which is exactly what we did in our exercise. We just linked them all together. Here we're linking together 400 and something cases. So our product is 564.82. So all we have to do is go get that 564.82 and raise it to the 1 divided by 470 minus 1, and that will tell you the geometric average. You can notice that the geometric, as we said, has to be lower than the arithmetic. So there's no formula in Excel that I'm aware of that does that, but there's the geometric average. Now, one thing you'll notice in the class notes is it says that the geometric average, you look on page 29 of notes, the geometric average, this is right before the section on risk, the geometric average should equal the arithmetic average times 1/2 of the volatility, or times 1/2 of the standard deviation squared. Let's see if that's true with Apple. So if I go up, we haven't done standard deviation yet, but I'm going to go ahead and calculate it, and we'll come back and we'll calculate it. So don't worry about this right now. I just want to show you. If we take the standard deviation, their monthly standard deviation, which is quite a high number, is 13.08. So if we take the geometric average plus 0.5 times the standard deviation squared, or times the volatility, that should get us something really close to the arithmetic average. And if we look at it, see, sure enough, very, very, very close. It's not identical, 221 versus 223, because this formula here assumes that Apple's returns are normally distributed, so there's a little bit of negative skewing to it, or actually positive skewing to their returns, but not much. So that shows us that, yeah, it does in fact work. And then we'll do the annualized geometric average. The exact same formula. We'll go grab that 564.82, and we'll raise it now not to the 1 over 470, but to the 12 over 470 minus 1. And then you see their annualized geometric average. We won't do that for the S&P because we don't need it, especially since it's going to be unfair because it doesn't include dividends. So we'll just leave that there. All right, so let's try some things here. Let's try standard deviation first. So let's look at the formula for standard deviation. And all these formulas are very, very similar. That's why I say these should not be formulas you have to look up. These should be formulas you know off the top of your head. That's why I'm saying it's so important that you be able to do this with a blank Excel spreadsheet. But standard deviation, the first thing we're going to do is take x sub 1 minus x bar. X sub 1 is each one of these returns. X bar is the average, the 2.23. We're going to take each one of those individually, and we're going to square them. So the sum of all of those squared divided by the total number that we have, we'll do all of that. So we'll do the sum of all of that each one of those squared divided by n, and then we'll take the square root of that. So let's see if it actually works. So the first thing we do is get the difference. So the difference, we're going to do this both for Apple and the market. So let me add a column so we can do that. So here's the difference for Apple. And here's the difference for the S&P. So we'll take negative 1722 minus the average, and you want to lock that in. So you want to make sure you have dollar signs, because we always want to subtract L7. So you want to put dollar signs on the L and dollar signs on the 7. So there's a difference, and then we want to square the differences. So you take the difference and you square it, and that's extremely important to finance, because what standard deviation is looking at risk, but the way standard deviation looks at risk is how far are you from the average. It doesn't care if you're above or below, because we're going to square this. So here we're saying, wow, we're really far from the average. The average is 2.23%. We were down 17%. We were 19% away from the average. It's negative 19%, but when we square it, we get positive 3.78. So there's two things to know about standard deviation. First, it defines risk as how far can you be from your average, which is another way of saying that, how far can you be from the expected value. And because we're squaring it, it only cares about the distance. It doesn't care if you're above or below. And also when we square it, outliers, the extreme numbers, are going to have much more impact than the numbers that are closer. So squaring causes big differences to be much, much bigger. So we can copy that down and we can copy it over to the S&P. The only thing I have to do on the S&P is change the average. So here the average is not L7, but it's actually in column N7. So I can copy that down. The difference squared for Apple and for the S&P. And so if you think about standard deviation, there's the formula in Excel. It's ST DEVP, open parentheses, and you highlight all of the cells. Let's see if we can calculate that manually. So we're going to do equal average, the average of all these differences. And we'll take the square root of that, raise it to 0.5. And let's see if we got the same answer. It looks like we did. So that looks good. That gives us the exact same answer. So look at what we did. We took the difference from the mean. We squared that difference. We then took the sum of all that divided by 470, which is the average, and then we took the square root of that, and there's our standard deviation. We can do the exact same thing for the S&P 500. And there you can see, using that formula for the S&P 500, the S&P 500 standard deviation on a monthly basis is 4.24%. If you want to annualize this, the way you annualize standard deviation, you can't multiply by 12, but because standard deviation is not, you can't annualize that in a linear way like that, but you can annualize volatility, which is standard deviation squared. And so what we can do is we can take standard deviation times the square root of 12. So that's very, very important to understand that this annualized standard deviation is the monthly standard deviation times the square root of 12. So for Apple, that would be 45%. And for the S&P 500, it would be 15%, which is just about right. That's what the market standard deviation has been. If you go back to the Great Depression, you'll get up into the 18-19% range probably. But the last 30 years, the market S&P 500 has been about 15%. So Apple stock is about 3 times more volatile than the S&P 500, but that's true for almost all stocks, and we'll talk about beta and how we look at risk in a portfolio context. All right, so we've got our standard deviation. So now what is correlation? So I'm going to add 3 columns. And let's look at the formula for correlation. It's very similar to the S&P. Here you start, it's a sum. You're going to take xi minus x bar, but instead of squaring it, you're going to multiply it by y1 minus y bar, which is the market. You have to do correlation, you have to have 2 things. We are again going to divide by n, and here instead of taking the standard deviation of this, or instead of taking the square root of this, we're going to divide by the standard deviation of x times the standard deviation of y. That's correlation. You notice that the formula, the first part of the formula is almost identical to standard deviation, except for instead of squaring, you multiply one asset class's difference by the other. You take the average of that, just like with standard deviation, and then instead of taking the square root, you then divide by the standard deviation of x times the standard deviation of y. So let's try all of that. So again, we're going to take the return of Apple minus its average, and we have to lock that in. I'm just going to lock in the 7 this time so I can copy it over. We'll do that same thing for the S&P 500. We take, well, it's Q instead of P, so you got to make sure you're referencing the right cells. So there's the S&P 500. There's Apple. Apple is Apple's return minus its average, and then for the S&P 500, it's the S&P 500's holding period return minus its average. And then we're just going to take those 2 things and multiply them. So if you think about standard deviation, it's asking how far can you be from the mean. Correlation is asking a very different question. It's asking when Apple is below its average, is the S&P also below its average? If they're both below their average at the same time, the multiplication will give you a positive number. If we copy this down a few rows, we'll notice here Apple was well above its average and the S&P was below its average. In that case, you get a negative number. So positive numbers means two things move together. Negative numbers mean they move in different directions, but all related not to zero, but to their averages. And so we should be able to copy this down all the way to the very, very bottom. And so the decorrelation, let's look at what we're going to do. We've got xi minus x bar times x1 minus x bar. Xi means 1, 2, 3, 4, 5, 6, 7. y1 and y2, y3, y4 times minus the average for y. We multiply those two. So now what we're going to do is take the average of that. The average of those multiplied differences. Divide that by 470. And we're going to take that entire thing and divide it by the standard deviation of Apple times the standard deviation of the S&P 500. Hit enter. Yeah, I'm worried that I did something wrong. We'll see. Yeah, there's something going wrong here, but we'll see. Average of 3 L through 4 divided by N, 470. Oh, I got Q2 times 2. No, that's right. O2 times Q2. That all looks correct. Let's check it because it doesn't look right to me. We'll do a correlation of Apple versus, we're going to use the Correl function, market. Yeah, so I did something wrong, so now we got to figure out what I did wrong. That's column O, that's all column Q. Everything looks right there. Everything looks right there. We multiply the two together. For correlation, we take, oh, I made a mistake here, so that's good. This is good test. The average already divides by 470, so sorry about that. So that's good. All right. So forget my divide by 470. If I took the sum, I would divide by 470, but I took the average. So when I hit enter, so that worked. And that's good. I made a mistake just to show you that while you're walking through this, you got to think through your logic. So the correlation between the S&P 500 and Apple is 0.45. R squared is a piece of cake. R squared is just correlation squared, and that we usually show as a percent. This is a very, very important number when we talk about beta. When beta is measuring risk, it's only looking at 20% of the volatility of Apple. It's ignoring 80% of it, and we'll get into that in more detail later. Beta only looks at what we call systematic risk or systemic risk. It ignores unsystematic or idiosyncratic risk. So Apple stock, 20% of Apple stock is systematic risk as covered by beta. 80% is unsystematic risk that can be easily diversified, and we'll get into that when we talk about beta. So when we do beta, the formula for beta is very simple. I can actually copy the correlation function down, and all I got to change for correlation, for beta, to make it correlation to make it beta is instead of dividing by the standard deviation of Apple times the standard deviation of the market, beta only considers market risk, so we only want to divide by the standard deviation of the market times the standard deviation of the market. So it's the exact same formula with that one change. So I'm going to do equal average of the sum differences, just like we did for correlation. This time I won't make the mistake of dividing by 470, and then I'm going to divide that by the standard deviation of the market times the standard deviation of the market, and that should get me Beta, that looks about right, 1.39. We'll talk about that in more detail. Now we're going to check it. The function for beta in Excel is equals slope, and you make sure you do the return of the stock first, comma, and then the monthly returns of the market, the S&P 500. Let's see if we get the same answer. Looks like we did. So I encourage you to try this. If this video is going too fast and you have a tough time keeping up, try it on your own, see how far you can get. If you're struggling after that, come meet with me, because I actually think it's really important that you be able to do this without any notes, completely a blank spreadsheet, be able to do all of these formulas so you understand standard deviation, correlation, R squared, beta. These are extremely important terms. And understanding what they measure. Correlation is the measure of diversification. R squared is a measure of how much of a risk of a stock is systematic versus how much is unsystematic. 20% is systematic, 80% is unsystematic. Beta is a measure of how much more systematic risk does the stock have. So of that 20% that's systematic, how does Apple perform? And they've got 39%, their systematic risk is 39% greater than the average stock out there. So we'll get into all those terms, but you can see how important these topics are. All right, we'll stop it there, and next time we'll get a little bit more into what we can do with some of these numbers, talk a little bit more about risk and return.